Hey listeners, strap in for another electrifying episode of the Tech Stocks Daily Podcast, where we dive deep into the heartbeat of the tech market. In today's Tech Spotlight, we dive into Apple's latest tussle, a continuation of the battle royale between the tech giant and Epic Games. Apple's decision to terminate Epic Games' developer account has stirred the pot once again, underscoring the ongoing feud over App Store fees that's kept the tech and gaming communities on their toes. This move blocks Epic's ambitions to introduce both the Epic Games Store and Fortnite on iOS devices across Europe, a development that Epic has labeled as a serious violation of the Digital Markets Act. Epic Games has come out swinging, accusing Apple of trying to throttle competition on iOS platforms and warning developers of the repercussions of competing against Apple or criticizing its practices. The skirmish is part of a broader legal battle initiated in 2020, stemming from Epic's accusation against Apple for its steep in-app payments commission of up to 30%, which Epic argues infringes U.S. antitrust laws. Despite these barriers, Tim Sweeney, Epic Games CEO, remains hopeful about reintroducing Fortnite to iOS through third-party app stores in the EU, capitalizing on Apple's move to allow alternative app stores on iOS in light of the DMA obligations. Meanwhile, Apple has rolled out its iOS 17.4 update, adding more fuel to the fire. This update is particularly consequential for users in the European Union, introducing changes to align with the Digital Markets Act. Among the laundry list of modifications, the update allows EU app developers to propose alternative app stores or to install their apps through these platforms. It also revises Apple's fee structure, including a significant reduction in commissions for apps distributed through the App Store. Additionally, the update facilitates the use of alternative browser engines besides Apple's WebKit, allowing browsers like Google Chrome and Mozilla Firefox to run on their native engines on iOS. Another notable change is the allowance for apps to utilize alternative payment options, moving away from the mandatory in-app purchases system. These developments come in the wake of a record EU antitrust fine slapped on Apple, amounting to 1.8 billion euros, over its restrictive practices against Spotify and other music streaming services. At the heart of this legal scuffle was Spotify's 2019 complaint regarding Apple's 30% App Store fees and associated restrictions, marking a significant chapter in Apple's legal battles within the European Union. The unfolding saga between Apple and Epic Games, compounded by legal and regulatory pressures in the EU, portrays a complex battlefield where the lines between technology, innovation, regulation, and competition continue to blur. As these tech giants navigate the evolving digital landscape, the outcomes of their struggles could define the future of digital platforms, developer rights, and user experiences on a global scale. CrowdStrike Holdings Inc. splashed onto the headlines again, but this time for setting the tech and stock markets ablaze with its fourth quarter results and future outlook, proving once more that cybersecurity is a burgeoning field that's only going to get hotter. Let's break down what made CrowdStrike the talk of the town today. In the fourth quarter ending January 31st, CrowdStrike didn't just inch past expectations. It vaulted over them with Olympic grace, posting a revenue jump of 33% year over year to reach $845 million, comfortably ahead of the $839 million estimate. The real cherry on top? Its subscription revenue, a vital part of its business, which rocketed up by 44% year over year to $795 million. From a $48 million loss last year to a net income of $54 million this quarter, CrowdStrike's financial gymnastics has been nothing short of impressive. The forecast from CrowdStrike also sent ripples of cheer across the markets, guiding for revenue between $902 million and $906 million for the coming quarter, dwarfing expectations yet again. And earnings per share? They're expected to be between 89 cents and 90 cents, making the consensus estimate of 82 cents look conservative. Part of CrowdStrike's strategy is eyeing the cloud as the next frontier of growth. It's a wild west of a market where even giants like Microsoft are constantly looking over their shoulders. Given the increasing complexity and frequency of cyber attacks, the demand for cybersecurity is evergreen, making CrowdStrike's services indispensable, even to those who are customers of other big tech names. This conviction is backed by the company's recent acquisition of Flow, aiming to bolster its cloud security capabilities even further. The cherry on top? The company is confidently striding towards its goal of accruing $10 billion in annual recurring revenue by the decade's end, having already hit $3.4 billion this fiscal year. If cybersecurity were an Olympic sport, CrowdStrike would be bringing home the gold. Today in the tech world, Microsoft grabbed headlines with a revelatory warning issued by one of its own. Shane Jones, a principal software engineering manager within the tech giant, has sounded the alarm on the potential dangers of Copilot Designer, a text-to-image generator developed by Microsoft. The tool, which was launched in March 2023 after initial testing in December, is under scrutiny for its capacity to produce images depicting sex, violence, underage drinking, drug use, political bias, misuse of corporate trademarks, and conspiracy theories. Jones detailed his concerns in a letter addressed to both the Federal Trade Commission and Microsoft's board of directors after his own testing yielded unsettling results. Jones's caution revolves around what he perceives as harmful content being generated from seemingly innocuous prompts. For instance, he noted that a prompt for a car accident resulted in an inappropriate image of a woman amidst wrecked vehicles, while pro-choice brought forth graphic and disturbing imagery. Concerned about the implications of these outputs, especially for younger users, Jones has pleaded with Microsoft over the past 3 months to either pull Copilot Designer from public use or significantly enhance its safety measures. Despite his efforts, including suggestions to adjust the product's age rating and add clear warnings, his recommendations have, so far, not been adopted by Microsoft. This controversy positions Microsoft at the intersection of innovation and ethical responsibility, grappling with the unintended consequences of their AI advancements. The company, while emphasizing its commitment to addressing employee concerns and ensuring technology safety, faces scrutiny not only for the contentious nature of Copilot Designer, but also for its internal response to the warnings flagged by Jones. As the debate over AI-generated content continues to evolve, Microsoft finds itself in a critical moment of reflection on the balance between pushing the boundaries of technology and safeguarding against its potential to harm. Today, Google made headlines for adding Nest Aware and Fitbit Premium to its Google One Premium plan. This news broke when users on Reddit and Twitter reported receiving notifications about these services being included in their Google One subscription. Google confirmed this update, which integrates both services into the existing £7.99 a month premium plan. For those not familiar, Google One is Google's cloud storage subscription service, offering a range of plans from 100 gigabytes of extra storage for £1.59 a month to a massive 20 terabytes for £79.99 a month. Before this announcement, the premium plan provided additional features such as access to certain workspace tools and a 10% discount on Google Store purchases. Now, with the inclusion of Nest Aware and Fitbit Premium, subscribers to the premium plan gain access to a wider array of services without any increase in price. It's noteworthy that this incorporation comes without a formal announcement. Despite the lack of official communication, the move aligns with long-standing rumors about Google's intention to enhance its Google One offering with these services. Although Google's plans and pricing page has yet to explicitly list Nest Aware and Fitbit Premium as part of the higher-tier plans, the general phrasing on the Google One site about plans coming with support for Google products might give the company the leeway to modify subscription benefits in the future. Currently, these extra services are available with Google One Premium plans in the UK. Google hasn't disclosed when these benefits will expand to the US or other regions. This strategy of pigeonholing more popular services under a unified subscription canopy reflects Google's broader objectives. Over the recent months, Google has been reshaping its subscription services framework, including raising the price for YouTube Premium and enriching YouTube Music with AI tools and better functionalities, highlighting a clear motivation to fortify its ecosystem attractively for consumers. All right, tech enthusiasts, today Meta Platforms has grabbed headlines, and if you've ever wondered why this giant is always in the spotlight, listen up. First off, Meta is not just about keeping up with friends anymore, it's a growth investor's dream. The company's forward momentum is powered by an astonishing projected earnings growth of 34.1% this year alone, dwarfing the industry's average of 23.9%. That's not just chump change. That's a serious indicator that Meta is on the move. Meta is efficiently turning its assets into sales, with a sales to total assets ratio of 0.64, hinting they know how to squeeze the most out of what they have better than most. With sales expected to grow by a whopping 17.7% this year compared to the industry's 10.4%, it's clear Meta is running its own race and setting the pace. Not to be overshadowed by numbers alone, let's talk dominance. We're living in the era of Meta's world, where Facebook alone boasts 3.07 billion monthly active users. When we say everyone's on Facebook, we're not exaggerating. And Meta doesn't stop there. They've got WhatsApp, Instagram, and Messenger in their arsenal as well, dominating the social media landscape with an astounding 8.0 billion MAUs across their platforms. In the realms of ad revenue and net income, Meta's numbers are just as impressive, showcasing their unparalleled ability to monetize their extensive network. The recent initiation of a quarterly dividend and a $20 billion stock repurchase underline Meta's financial strength and commitment to delivering shareholder value. With ad revenue growing 24% year over year to $38.7 billion and net income more than tripling to $14 billion in the fourth quarter alone, it's clear Meta is on a financial upswing. So there you have it, folks. Meta isn't just surviving, it's thriving, dominating, and undoubtedly inventing the future of social networking and digital investment spaces. With such impressive growth and dominance, Meta Platforms is definitely a force to be reckoned with. Now, I want to hear from you. What are your thoughts on Meta's monumental growth and internet dominance? Do you think their streak will continue, or are there challenges ahead that could slow them down? Drop your thoughts, insights, and foresights in the comments below. Let's get the discussion rolling. Today's tech market sentiment, based on the reporting from the Comprehensive News Digest, shows a fascinating blend of optimism, innovation, and cautious regulatory engagement across key players in the technology and digital platforms landscape. Starting off with Apple, the company seems to be navigating through a mix of regulatory challenges and opportunities. The recent iOS 17.4 update, in response to the European Union's Digital Markets Act, portrays Apple as adapting to regulatory demands by enabling alternative app stores and reducing app store commissions. However, these changes come amidst legal battles, including a significant EU antitrust fine, suggesting a cautious optimism as Apple adjusts its strategies within the European market. CrowdStrike stands out with its impressive fourth-quarter results, showcasing a burst of positive sentiment within the cybersecurity sector. The company's revenue jumped 33% year-over-year, with subscription revenue up by 44%, marking a significant financial turnaround. CrowdStrike's future outlook indicates a strong demand for cybersecurity, buoyed by strategic moves like the acquisition of Flow to reinforce its cloud security capabilities. This paints a bullish picture for CrowdStrike and possibly the cybersecurity industry at large. Microsoft, on the other hand, is caught in a nuanced situation with its text-to-image generator, Copilot Designer. Despite the company's innovative strides, internal warnings about the potential generation of harmful content highlight the ethical and regulatory challenges facing AI technologies. Microsoft's reaction to these concerns and how it balances innovation with ethical responsibility remains a critical narrative in shaping market sentiment around AI advancements. Google injects a dose of excitement with its integration of Nest Aware and Fitbit Premium into the Google One Premium plan. This strategic move, enhancing the value of Google One without increasing costs, signals Google's ambition to solidify its ecosystem's attractiveness. While the absence of an official announcement calls for cautious optimism, the initiative reflects Google's ongoing efforts to refine and expand its subscription services, potentially boosting its market presence and consumer appeal. Lastly, Meta Platforms draws attention with its impressive growth indicators and social media dominance. With projected earnings growth outpacing the industry average and a commanding presence across Facebook, WhatsApp, Instagram, and Messenger, Meta illustrates robust financial and market strength. Initiatives like a quarterly dividend and a $20 billion stock repurchase further underscore Meta's confidence in its future trajectory, making it a beacon of optimism for investors and industry observers alike. In summary, the overall tech market sentiment today radiates a mix of optimism, fueled by innovation and financial growth, tempered by the challenges of regulatory compliance and ethical technology use. The dynamic responses from industry giants like Apple, Microsoft, and Google, alongside the bullish outlook for companies like CrowdStrike and Meta, mirror the complex, evolving nature of the global tech landscape. Focusing on CrowdStrike Holdings, Inc., it's clear that the company's performance and outlook place it in a very promising position within the tech stock market. The summary of their fourth-quarter results for the period ending January 31st showcases quite an exceptional trajectory. CrowdStrike far exceeded expectations with a 33% increase in revenue year-over-year, reaching $845 million, surpassing the forecasted $839 million. Equally notable was the 44% year-over-year surge in subscription revenue, amounting to $795.9 million, a pivotal component of their business structure. Moreover, CrowdStrike transitioned from a $48 million loss last year to reporting a net income of $54 million this quarter, an achievement that speaks volumes of the company's robust financial health and operative efficiency. Looking ahead, the company projects revenue to be between $902 million and $906 million for the next quarter, with expected earnings per share between 89 cents and 90 cents, thereby outpacing the consensus estimate of 82 cents substantially. CrowdStrike's strategic focus on cloud security marks its intention to capture the next wave of growth in a segment brimming with opportunities. This approach, coupled with the increasing frequency and sophistication of cyber attacks, renders CrowdStrike's offerings indispensable even to clients of its competitors. The firm's ambition is underscored by its acquisition of Flow to enhance its cloud security capabilities and its aim to reach $10 billion in annual recurring revenue by the end of the decade, having already achieved $3.4 billion this fiscal year. Given these impressive performances and promising forecasts, I would definitely recommend a buy for CrowdStrike Holdings Inc. The momentum behind its operations, its strategic positioning within the evergreen cybersecurity market, and its ambitious growth targets indicate strong potential for continued success and value appreciation. Note, this analysis is for informational purposes only and should not be considered financial advice. Investors should conduct their own research or consult a financial advisor before making investment decisions. Past performance is not indicative of future results. Today's tech world buzzed with activity, blending innovation, financial growth, and cautious regulatory engagement across the spectrum. Pinning the day's highlight, CrowdStrike steals the show with its astounding financial turnaround and promising future prospects, making it a buy for those looking to add some tech flair to their portfolios. And there you have it, folks. A day full of tech twists and turns, from legal dances to financial U-turns and innovation sprints. If you found these insights sparkly, do what you do best. Like, subscribe, and share this video far and wide. Don't forget to hit that bell icon so you won't miss out on our daily tech news rundown. See you tomorrow for another round of Tech Tales.